Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
So, guys, we have a lot to talk about today. I know I kind of say that every week.
Every week.
This last week, some really important things happened. Number one, we're going to talk about the Federal Reserve leaving rates unchanged, and then here's what that means to you in your wallet. We're then going to cover the latest Real Estate Commission lawsuit is the scariest of them all, the headline reads. We'll see about that. I got some comments to bring you got. We're going to talk about some more success stories today and how people are using mortgage as solutions for their financial trials. And then we're going to close out with the Zillow executives imagining a world without buyers agents. I don't think so. Let's get into it. First topic today, guys. The Federal Reserve leaves rates unchanged. Here's what that means for your wallet. Last week, Jerome Powell and the Fed came out and said, pause, we are not going to be raising interest rates, and we're going to continue to have rates elevated higher for longer. This obviously has something that means on the surface, and then it has a little bit more long-lasting durational effects. So what did you guys take from the press conference? What are you looking at? What are you skeptical about? I got a couple things.
All I can say, it's about time.
Yes.
11 consecutive interest rate hikes since March of 2022. That is crazy. This is great. Like, it's just applause, right?
Yeah.
But hey, let's not get excited.
Yeah, I think there's a little bit of room for caution. I was looking at the graph that connected to the article. I'm like, man, that is one steep incline.
Yeah.
Spike up.
Massive steep incline.
Yep. And we got to remember the FOMC is going to meet
in December.
In December. So who knows what's going to happen there.
And that's what I wanted to basically come in and say that right now it's not stopped. It's not done. It's just like, let's just wait and see how data comes in next time around that we meet in December. And I'm going to go out and say that I think they're going to go ahead and raise it up, that in December, because you saw how the market took it these last couple of days that, it took it very positive. But if you've seen previous times where they do something like this, we get that market pickup, but only for it to come right back down once they, fully let us know their sentiment.
Yeah, it does have a whipsaw effect. It's kind of like the initial shock value or novelty of the decision makes the direction go in one direction because everyone's interpreting, this means something in one way or another. But then more data comes out, more of it kind of like the dust settles, and we go, okay, well, what does that actually mean? Because here's what's going to happen in 2 weeks from now. Their notes are going to come out.
Yeah,
and then the market's going to react to their notes coming out. Oh, what'd they actually say? How'd they come to this conclusion? But I mean, look, they're kind of already tipping their hand at the same way. They're saying higher for longer. So that means that even if they do stop here, or even if they have to do one more quarter point rate hike, either way, it's going to be here for a while. I don't think anyone in their right mind can be advocating that they're going to see a Fed funds cut in the first quarter, second quarter. There's no reason for it until there is a reason that shows up. I don't expect there's going to be one.
Yeah, it's like a suspenseful movie, No,
100%.
What's going to happen? We're just kind of biting our nails here.
And Patrick Bet-David said it best. Like, if they do bring interest rates down anytime soon, what do you guys think is going to happen to the market and those prices? Well, they're going to swarm right back up.
Go right back
the
up.
market's going to get inundated with buyers again, and then we're back to the same problem that we've never been able to get off. So,
and I think this is part of what's confounding a lot of the people that I watch online and on YouTube, and we get some of these comments too. And it's like, hey, this is what happened last time. And like, I know that's what happened last time. But here's the thing: there are so many differences in what's happening now mechanically than what's worked in the past. Because what worked in the past isn't actually showing like it's going to work right now.
Nope.
Because if it were to work right now, and we're already 19 months into this, it would have already started to show up. Yeah. It's not showing up. Prices aren't correcting as fast as they should. Inflation is still in positive territory. It's not negative. So this argument of, in the past this happened, whether the past was the 70s or the past was the dot-com crash or the 08-09 collapse, this is not the same deck of cards.
Not at all.
And the outcome should not be compared to that, proportionate to the amount of variables and the types of variables that are impacting what we're seeing happen right now.
Yeah.
And then again, the federal funds rate is tied to credit cards, auto loans, student loans, or personal loans. So it doesn't necessarily directly affect the mortgage rates, although the Treasury is the one that more or less, gives you the closest thing to knowing if rates are up or down. But at the same time, the biggest thing that I get from here is that, consumers are using a lot more credit and they're still spending. So it looks to me, when are they going to hit that period of, hey, I'm done, no more credit. But I did see that, job reports came in a little bit lower than before. So maybe this is going to be that, that starting tip to where we start seeing spending go down. But I'm curious to see how Black Friday plays out.
Yeah, well, we'll see about all that good stuff. The good thing is right now, people who are actually saving their money, they're actually getting paid by the bank.
Yeah.
I kind of did like who's paying what, right? And I see this bank, UF Direct, offering a 5.5 APY, annual percentage yield, right?
Wow.
So they're actually paying you for storing your money at a bank account, which is not too bad because you guys remember not even a year ago, they were paying 0.0 whatever, not even 1%. And here we are. Now they're paying 5.25%. So the way the banks look at it, hey, the more that we incentivize the consumer to save their money here at our bank, right? Then we can actually loan it out for more. Since we're already borrowing for the federal government at 5.25%, 5.5%. What now they look at it like, well, we just might as well just go to the consumer.
Yeah, and it's an arbitrage play, right? It's always that way. It's how much they're going to borrow the money for, how much can they lend it out for, and that spread between becomes margin of profit. And the APY, 5.5. I've never seen that as an adult.
Yeah,
it hasn't been the high in decades, right?
I'm sorry, 5.25.
5.25. Okay, fine.
That's
5.25. I still haven't seen anything in the fives in my adulthood.
I've never seen anything in the fives in my whole adult life.
Oh, but wait.
Your
I
entire
missed
life.
it.
Yeah.
I missed it. Citizens Bank is offering 5.5 actually APY,
Okay, wow.
while SoFi is offering a 4.6.
Yeah. And I mean, and then again, any of those that are actually outpacing real inflation in your life, I'm going to qualify that. Disclaimer, asterisk, check me in the comments, that are in your real life. The inflation in your real life, including your food, your rent, your clothing.
There it is, okay.
Any way that number is outpacing that, then that's a safe bet for people to put some money away for a secure period of time and then come back to it later with a little bit of gain.
Yeah. I know, like when my mom sold her house, we put it at her bank. It didn't make anything.
Right.
There's no interest. At least this way you could put it in there, make something, it's, and it was quite a bit of, I can't believe Mom. Good job. Two thumbs up. She saved quite a bit.
And I think that this kind of goes hand in hand with the debt conversation because we're talking about credit card balances in the U.S. Crossing the $1 trillion cumulative total for 1.02 trillion. But here's what's really gnarly about that, guys, is it was as low. I know it's a relative statement. As low as like 750 billion less than 2 years ago, or let's just say 2 years for the ease of conversation. Let's say 2 years ago it was 750 billion. Now it's $1 trillion, and in 2020. It was about 850 billion. So we have like really rapidly at the same clip that the Fed has increased rates. We are assuming more debt as consumers, and this will have to have a day of reckoning.
Yeah, we're almost like a government, just continue.
We're just keep borrowing more and spending more.
Proportionately, we're actually better than the government.
Borrow more. Spend more.
I know they're at 133 trillion, right? But we're only at a measly 1 trillion.
Depends on the number you're talking about. Yes. But the rate at which they're accumulating it is way faster than us as consumers.
Yeah.
There is something interesting, though, I wanted to share with you guys, is that when I looked at how much home equity there is left,
my God.
On average, like the national home equity, I think in this article, they said there's 31.6 trillion worth of home equity. Now, this is according to Jacob Channel, senior economist at LendingTree. Yeah. So if all of that $1 trillion of consumer debt was paid off, there'd still be 30 trillion of equity left.
Yeah.
So here's the thing. I want to make sure I demonstrate to people when I talk about in this part of the show. We hear a lot about, home equity lines of credit at 12%, 14%. That's absolutely crazy. Well, in the same article, the average consumer's credit card adjustable rate for their credit is 20% or higher.
That's high.
So you're swapping a lower rate, yes, connected to your house. But again, if you have all this equity, you're making the house do some of the heavy lifting. I understand why people have their personal preferences that they don't want to do that. That's fine. Spend your cash. You can spend your savings. You can spend money from your investment account to pay off your personal credit debt. But for some people, the house is the answer to their current problem, depending on how big that problem is.
Yeah. Yep.
No, 100%. And to that point, I feel like, people not looking at their house as a solution is in a way hindering yourself because you have an asset there that can just continuously replenish itself as the values continue to go up. And in San Diego, values just continue to go up, and up. But my thing is, to what point do homeowners need to get for them to say, oh, you know what, I'm actually going to tap into my equity that I have that I could have, been out of this, storm months ago, but now I'm going to go into it.
I think some of it has to come out with pain. And the other side is the opportunity. So where there's a pain point where maybe someone has, like we used in a previous example in a show, like $100,000 of consumer debt. Yeah. Okay, that's not a really good situation. If you have $400,000 of equity and $100,000 of consumer debt, now what you're saying is you're going to have only $300,000 of equity, but have your consumer debt paid off. Oh, but there's a HELOC payment. Correct. But that HELOC payment in Brian's example took their out-of-pocket expenses down to $700 from $2,000. They saved $1,300 monthly on their budget. Yeah. So that's a solution for somebody. Oh, well, but you've chipped into their equity. Okay, fine. Let's play that game. Let's say they sell their house in a year from now. Yeah. They still have $300,000. They have paid off all of their debt, and they have whatever payment they have left. If they're going to sell their house, then guess what? That line of credit gets paid off too, guys.
Wow, you did all that math in your head right there, huh? Andy?
Yeah, I did, because we talked about
beans.
I did because here's why, guys. Like we are going to run across these scenarios. There are people like catching on to the videos now, watching and commenting and having these exchanges with people, and they're very healthy. They're very good. And I understand where people are coming from. Not everyone lives in San Diego or California where we're talking about $400,000 of equity. I mean, recently someone just posted like, hey, I just bought a house and my payment's like $500 and it's going up to $530. Like, that's amazing. That's not here. Jeez. So we're talking about $400,000 of equity. You had an example earlier. Someone's got a house. Maybe the value is about $1.5 million.
Yeah.
They own about $1 million. That's still 65% LTV roughly on $1.5 million home. But that's where we're dealing with here. And people do have a solution. Even if you don't like it or you think it looks kind of ugly, for some people, if they're in enough pain, they're going to have to consider something.
That's what I was, and that's what I was saying last week, where it's like, well, you have to value which one's going to hurt more. You know, the value of you not paying your stuff or not being able to keep up, or taking that Band-Aid out right now, putting it on, slapping it on, and then in a year and a half, you could rip it off. And
just remember, when you're kind of consolidating everything to one, it kind of feels like this huge burden's off of you, because you don't have to worry about, dang, is that one on auto pay, or do I have to send a payment through this? It's like when you have multiple payments, like, I hate even going to the mail.
Yeah.
You know what I mean? Good thing is, I don't make any payments, so I don't have to worry about that. But
for those who do,
for those of you
that have that problem, there's a solution. But I wanted to make another point. This is more of a technical point, guys. But look, if the Fed is pausing, and this is the pause, let's say there's no other rate cut. Let's play out that scenario. That means if you do get yourself in any sort of adjustable payment right now, then you're looking at that same payment or lower when they start lowering it. So anything that's connected to the prime rate that you secure now, whether it's an adjustable rate mortgage, it's a credit card, it's a line of credit, if it is tied to prime and that prime starts marching its way back down the stairs over the next 24, 36, 48 months, then that payment associated to that payment method is also going to decrease on the monthly.
Yeah, for sure.
Wow, that's a very creative and lucrative option that you can take if you're betting on saying, hey, rates are going to come down, which we all kind of know in the next 10 years, 5 years, they are going to come down.
Yeah.
Slap a 5-1 arm on that and call it a day.
It's just a technical thing.
It makes perfect sense.
There's going to be a variety of opinions, I'm sure, but again, it's not for everybody. But in some scenarios, that might make sense to do now because your other option may not be as favorable.
Yeah,
and so it's a risk that people are willing to take, just as much as it's a risk to be in a fixed position for 30 years too. That's a risk. People don't think it is. They go, oh, that's the best thing. Well, not in every scenario. Honestly, it isn't.
One of the approaches I'm taking right now when I speak to clients, they ask me for my professional opinion. Hey, what would you do? Would you buy this house and rent this one, or buy it and sell the one that I currently have? My response 99% of the time is, well, let's take a step back. What is your long-term goals looking like? What is it that you want to do in the next 5-10 years?
Yeah.
Then make the decision based off of how close that's going to get you to where you want to be. And then I give them my personal opinion. If it was for me, I would rent the house because I know rates are going to come down. You're going to have a cash cow here in San Diego. Later down the line, you can always refinance and then even get more on your rental. But if you want to take the route of cash out, you have a win-win either way. It's just what's your long-term commitment and what are you looking to do?
Well, here's the thing, guys. The good thing is there's data out there.
Yeah.
So we could always look at the data. And you could be very hyper focused on the areas. What has it done in the last 10 years, 15, 20? It gives you a general idea. Everything we're going through right now is just weathering the storm.
Yeah.
Just like we have 4 types of weather, right? It happens in an industry too. We also have to weather some storms. And you know what? We've been dealing with an excellent no rain, no thunderstorm real estate storm for many years.
Quite a while, yeah.
And so, things have to balance out. They have to adjust. If we continue to have prices of homes continue to go up like that, really, and incomes are not going up, right? There is just no affordability.
Yeah.
So something has to give.
Yeah.
Something has to give. And so going back to this, the consumer debt with credit cards, again, it's inflation.
Yeah.
The consumers paying more for foods and goods and services, and therefore they're charging it, and so that's why we're continuing. The craziest thing is we haven't seen such a high debt since the New York Fed began tracking this back in 1999.
Yeah.
So that's a long time for us to be able to see this.
Yeah, it's pretty unprecedented, and it's not going to get solved easily, I don't think.
No.
But it is what am I trying to say? It's a symptom. It's a symptom of the problem. Yeah.
I guess.
It's more of a symptom of the real problem underneath that. But
and then access to credit too, guys. Remember,
it's changing.
It's very well. It's it was so easy.
Yeah,
right.
Now it's going to start getting kind of tapered back.
Even with the HELOCs in a couple of months, it's probably going to be a little bit more difficult to get one.
Absolutely. You know, on the good note, the good thing is delinquency rates for people paying consumer credit is really low.
Yeah, I did see that.
You know, so it's really, really low, which is great. That means people are working, people are still being able to pay, so it's not a bad thing.
And that's what I think is happening, that people are still working, they're still getting paid, so therefore they're like, hey, it's getting more expensive, but hey, I'm able to weather the storm,
Yeah.
so hey, I guess everything will be good once it gets fixed, right, Fed?
Yeah, relative. It's relative.
I'll just keep spending like you guys.
It's relative and proportionate.
Right, Uncle?
Pow, pow, pow. Yeah.
Hey, you
relative
got any
and
more of
proportionate.
those, printing machines out there?
Me too. Yeah.
All right, guys, let's go on to the next article for the day. The latest real estate commission lawsuit is the scariest of them all. So this is a new lawsuit that came out literally just hours after the Seitzer-Burnett commission lawsuit that just got basically decided last week as well. And this is because it's all about buyers' commissions and who needs to be paying for that, how it should be paid. I got a couple ideas about this, but I want to read this first from the article. The new lawsuit known as Gibson, after its lead plaintiff, accuses the National Association of Realtors, Compass, EXP, World Holdings, Redfin, Weichert Realtors, United Real Estate, Howard Hanna, and Douglas Elliman of conspiring to inflate real estate agent commissions. So this is a piggyback of what we already saw get concluded with the Seitzer-Burnett case, where there was, I think, a $1.7 billion. Was it 1.7, 1.8 billion dollar? Basically, it's a penalty that has to be paid as a result of buyer commissions. But I have a couple opinions about this. What are some of the things you guys wanted to note about what the case is, what it means, before we get into what we think it means moving forward?
To me, it was a little bit confusing as far as what was happening. But from my understanding, it looks like for sale by owners are a little bit upset because their houses aren't getting that much attention due to the fact that, hey, they don't want to sell, they don't want to pay for a commission to the buyer's agent. Therefore, what it said in the article said that, hey, those buyer's agents are less lenient to show that house because of the fact that they're not getting a commission from that seller. So I guess it's one of those things where it's like, well, they mentioned pay to play, right? So,
well, right. Okay, so you bring up a good point. So for sale by owner also means they don't have a listing agent. So they're already trying to sell it on their own, which is fine.
Yeah.
It doesn't bother me that people want to do that. What typically happens, though, is people that want to do for sale by owner still end up needing someone inside the industry, like an escrow officer or a transaction coordinator, to make sure that all the paperwork is done properly, all the I's are dotted, T's are crossed. So there's still a technical necessity for there to be someone of knowledge and capacity to help you close escrow. In this case, when it comes to lawsuits like this, it might seem limited to the few up front, but then it starts having a industry-wide impact over the course of time. So these things are going to take time to not only have the dust settle, get the payouts all settled and all that and dispersed, but then also what rule changes now need to be implemented in order for everyone to kind of follow suit so that this doesn't happen again. Yeah. So one of those things I was talking about kind of pre-show was, listing agreements already have the commission in it. So if I'm a realtor and I'm going to present to you to sell your house, I'm telling you how much I'm expecting for commission as a return on what it is I'm going to do to sell, promote, and market your house, which includes how much we're going to pay the buyer. I don't know that a lot of people are aware that that's negotiable. It's not a fixed fee. You can talk to me about that. Number one, you can choose not to. You can ask for a lower one. Or guess what? You can find a different agent. There's agents that do commissions all over the place. It's not just, it's 6% for me and 5% for him and 1% for them. And this is my problem with the lawsuit. There are already a variety of agent commission levels that are agent specific, not just company specific. Remember 1%? Like, I'll list your house and sell it for 1%.
Where are they at?
Okay, so do we have a lawsuit of commission against those people too? Because it's still 1%. No, we don't. We're talking about other people that maybe have higher, but that's kind of just the surface layer. I got some other things. What do you guys think about that?
Yeah, it was like your help you sell, right? They were kind of, and they're not around. But maybe it's because what they're saying here in this lawsuit is, agents, their fiduciary duty is to show any homes that are available, and so you're not sharing that home because it might not be paying that 3%, that 2.5%, whatever it is, right? So maybe Help You Sell went under because they were only paying like about 1%. They're like, well, we're not going to show those homes. We're going to be a little, less prone to show that because of the commission. So that's what almost all of this is all about. But I think every industry needs to have some type of rules, regulations to protect the consumer. Just like the SAFE Act was provided for us.
Absolutely.
It used to be the Wild Wild West back in the day, right? Until 2012 when the SAFE Act came into place, and now we have to, it's all about consumer protection, making sure that they understand they're able to go shop around for the best rate, and they're getting, a loan estimate, a CD. So all these things come into play. I just think this is just kind of like another way how real estate's going to change. I don't think we're going to get rid of the realtors. I really feel like your big Zillow fintech companies are trying to maybe do that and just do everything through technology, but I really think that any consumer, I'm still going to want to go and have representation from a realtor to open a door for a home that I can actually visually see.
Yeah.
And so a lot's going to change.
I think there will be some changes. I think it's going to be industry wide. I think it's going to mostly be contractually, number one. Number two, then people will adopt it. And number three, this has to be carried all the way through. You have to follow the entire pipeline of the transaction from this one decision in this point in the pipeline all the way through, because that does mean something for sellers too. In every single case there's a seller, they immediately become the buyer. Unless they died and it's their estate selling their house. If you're a seller right now, you immediately become a buyer of the next place you're going to go purchase. So this means something for you as a seller, because you'll be a buyer the second your escrow closes. So take that into mind and remember that too. Because one of the shifts they're trying to make is say, oh, okay, well, buyers are going to be responsible for paying their agent. Well, okay, here's the thing though. Every single price of a good that's connected to a commission-based salesperson, I pay for as a consumer.
Of course.
I don't care if I'm buying a couch, I'm buying a car, I'm buying a watch at the jewelry store.
Yeah.
Guess how they're getting paid? Commissions. So to say that, they're inflating and securing the price and keeping it high by baking in the commissions, that's true for every sales job. I don't care if you go buy a Ferrari, you buy a Rolex, or you're at the store buying a couch or a mattress, that sales commission is baked into the price because that's how it works. So are we going to see lawsuits for these other industries, guys? Furnitures, cars, and watches.
Wait, we'll see.
You never know.
I think
Nordstrom sues. Watch out.
But that's true. How are companies going to operate if there's no money coming in, right?
Well,
like
it's
you're not getting paid
people
for your services.
It's baked in. When you go buy a chicken sandwich down the street, guess what?
Yeah.
The cost of the employee to make it, to serve you, and give it to you, and clean up after you, that's built into the cost. They don't call it a commission because they get paid an hourly wage, but it's still built in the cost. Everything works that way.
Yeah.
So you guys just see how McDonald's increased their hourly wage?
Yeah.
So did you also see how the Big Mac is now almost $20 as well?
What?
No, it's not. Are you for real?
I saw it online the other day. I sent you the.
Hey, by the way, I'm super glad I don't know that. I feel like I'm making better choices.
Yeah, you are.
It's because I read it. I don't know. I wasn't there.
No, it's not.
Yeah.
No, you've been down at the donut shop.
Yeah.
So here's the other thing I wanted to say about this commission thing, guys. People have a choice to buy a house. Yes or no?
Yes.
Okay.
Choice.
Now,
yes.
they have a choice. Now, does the agent decide which house you should buy?
No.
Okay. Who decides what house they're going to buy?
The buyer.
Okay, so one of the things about this is that they're saying that, agents steer buyers towards homes that pay greater commissions. Now, admittedly, can that happen? Yes or no?
Sure.
Okay, that could happen. If I don't like that house, I don't want to buy it, regardless of what the commission is to my buyer's agent.
Yeah.
If I don't like that house, if it's outside the region I want, if I can't afford it or whatever, pick a reason.
Yeah.
As a consumer, I'm going to buy the house I want to buy, regardless of what that commission to the agent is. Yeah. And then their argument is, well, agents aren't showing all the homes. Okay, here's something cool. You brought up Zillow a minute ago. You know where Zillow gets all their listings online from?
MLS.
From us.
MLS.
Yeah.
Literally everything you see on Zillow is being farmed from the source of MLSs in all of the areas you're looking.
Yeah.
So this whole point about, agents are only going to show houses that they have access to so they can see, tell a buyer that gives a 3% buyer side or 2%.
Yeah.
That's garbage, because I can go on Zillow right now and tell my agent, I want to see this house, because now I have access to it.
Realtor.com.
Same thing. Yes. Same thing.
Redfin.
Trulia. I don't even think it exists anymore because Zillow bought it.
You could just Google.
Same thing. So my whole argument here is like, look, people are going to buy the house that they want to. And because MLS has allowed themselves to be full frontal, I will say, to the Zillows of the world, the Realtor.coms of the world, then any consumer can go look at any house that they want online, regardless of what the commission is, and say, agent, take me there.
Yeah.
It's your fiduciary duty to show me this house. I want to consider this one. I don't care what the commission is.
Yeah.
That, to me, makes this whole thing null and void, bunch of crap.
Yeah. I didn't see Berkshire Hathaway.
Well, you're not going to see a lot of these in here. Well, were you trying to make a point?
Yeah.
Are you trying to make a Warren Buffett point?
There you go.
Okay.
Are they just trying not to mess with the big dog right there?
But here's the thing. You're right in the fintech space is that eventually they're going to try to get rid of as more people as possible, or let's say just consolidate the process to get direct to the consumer. That's always been the goal. But we're literally handing them the access to that. We've had this argument inside the industry for a long time, whether you're a banker, you're a broker, you work at a real estate company, you're a broker, or whatever you do. The whole thing is like we're giving them access to everything, which is fine. But then the solution that the market is suggesting to eliminate this commission problem is to have a pay to play, which is exactly the same thing that they just did a lawsuit against.
Yeah.
It doesn't make any sense when you look at it that deep.
It's like pointing fingers at each other.
Yeah, it's pretty stupid. So, lastly, I'll close with this from Gen Kelman, who's the CEO of Redfin. He says, change in whatever form it takes can be painful for many industry incumbents, but it would be good for consumers, good for innovators, and good overall. I spent the first year or two of my now 18-year Redfin career proclaiming every other month that a revolution was at hand, only to discover how impervious to change our industry is. Impervious to change our industry is.
So is he's a high-end from fintech executive?
That's correct.
And it benefits him to be the one sole place where they could go and search, obviously.
It does. It does. But again, now they're going to cross-compete with each other too. And guess how they're going to have to, how are they going to entice people to show better the homes, one versus next? By how they pay.
Yeah.
Guess what? And how
Pay
much
to
you
play.
make is commensurate to the listing price of the house. So I'm sorry, if you live in a place with a low-cost area versus a high-cost area, the commission take-home is going to be dramatically different. No matter
like I
what
mentioned
place
earlier,
size
there's
it is.
data out there, which is a great thing. There's data out there. We can see how much money they lost. If you look at the Zillows, they didn't lose in the millions. They lost in the billions.
Yep.
Open Door lost in the billions.
Go check it out.
You know, and now they're trying to get some of that money, and that's why they're doubling down on all their marketing and everything, because what they see is, you know, it's a $1 trillion industry here that we're dealing with.
Yeah.
Yep.
So if we get rid of the middleman, well, hey.
We are the man.
Yeah, we are the man. So they're doubling down on
Yeah.
that
Yeah.
what's being said out there.
So to everyone who's mad about what our opinion is about, agents should be making that much money anyways. Okay, I expect you to be mad when you tell that to Zillow too, and to Redfin, and to everyone else. That's now
good
gonna,
luck talking to a real person.
Gonna scrape. Yeah, no, I'm just saying, be mad. You want to be mad about the issue? Be mad at everybody regarding it. Don't just be mad at the
exactly.
agents trying to do their job and to help you find the right house. You can go be mad at Zillow. Go knock on their door and yell at them. All right, next topic, guys. We got solutions in the market. You guys both have something you want to talk to about today, to the audience about ways they can affect change in their life personally right now by doing certain things in the mortgage space. So Memo, why don't you go first? Tell us, what did you bring today? What are we going to talk about?
Well, some of the solutions is like, it's not tailored to everyone. The numbers got to make sense, you know, but obviously you have to have the right documentation, everything to really figure out what's the best solution in this case. So in my solution case was great. And we found it to be very lucrative for the actual client. So we did a VA cash out back in 2021. We actually did a VA IRRRL. So we reduced his rate from, it was like 4% down to a 2.625% with a balance of 412. So he had a payment of $27.82, which is phenomenal. Like, hey, you know, 3-bedroom, 2-bath, Murrieta. This is a great thing, right? So he was just getting a lot of debt. He's like, I have a lot of debt. My daughter got in an incident. I just feel like I'm paying too many payments. I just want to get out of this. I want to leverage my home and the equity that I have in there in order to just kind of feel like less burden. So what we ended up doing is we did a cash out. We got about $105,000 for him so he can pay off some debt. The VA was cash out for 105, but that was also his debt. Okay. And the total monthly payments on that was $28.65 a month.
Whoa, out of pocket?
Yes.
Woo.
Right?
So $28.65?
Correct.
$28.65, okay.
So we ended up doing a new loan amount for $530,000, which took him to a 97.7% loan to value. That was about $118,000 cash out.
Okay.
Okay. So what we did is we're going to pay off the 105.
Mm-hmm.
Okay. So his old payment was $27.82.
Right.
Plus a $28.65 put him at $56.47.
$56.47, yeah.
His new payment at 7% interest is actually $4,419. And it sounds like, what the heck? We went really high.
Whoa.
Really high. So if you go $56.47 minus the 44, that's $1,228.
Yeah, that's a huge
savings
swing.
a month.
That's almost exactly what his was last week, which his was $1,300.
Yeah.
$1,228. So $1,228 of monthly out of pocket to the better, to their benefit.
Yeah, to their benefit. So that's what and so he took the whole thing like, I'm going to go refinance. I'm going to owe more on my home. The way he looked at it is, I don't have car payments. I don't have credit card payments. I don't have all this payment. And so here, it doesn't stop here, guys. So not only does he save money there, so we actually do a mortgage accelerator calculator. It kind of looks like this. I got a calculator. It's pretty cool. Yeah, we'll put it up on the screen. So with the VA funding fee, it's not $530. It took it to $547 because remember the subsequent use. Active takes it 3.3%, although it sounds like whoa. So my thing is always reinvest back into yourself. Don't utilize that $1,228 and say, okay, now I can go and get more credit card debt. No, on the contrary, reinvest in yourself, right? So if he reinvested in himself and just said, I'm going to put the $1,200 back and put it towards my mortgage, on your mortgage payment, you could actually get right there, pay additional towards principal. Well, do the $1,200. Okay.
Well, because he's already paying that out of pocket anyways.
That's correct.
It's a net gain for him monthly out of pocket, but he's used to paying that because of the credit card debt. But
That's
paid
correct.
It off. Okay, go ahead.
Exactly. So with that said, I show that he will be back. He will owe $412. Remember, that's his current balance, $412 and change. Mm-hmm. In 5.5 years, he'll be at $412,797.
Oh, wow.
Wow.
How long does it generally take to pay off credit card debt and all that? The norm
you're talking 20 or more.
Usually they say it's about 13 plus years, right?
Yeah, but let's be real. With people we talk about, they are 13 minimum.
Yeah. So in 5.5 years, he'll be back where he's at.
That's
currently
crazy.
But check this out. It doesn't stop there, right? Because when you have the right tools and you show the right, you really start helping the consumer visualize how much better off they'll be. Okay. So if they continue to make that payment all throughout, they will pay off their house in 15 years and a half.
So they pay it off faster if they just do that? Of course,
because it's all principal. You're continuing to pay,
that's half as fast.
That's correct. That's it's $1,200 going. That's a savings, Andy, of $414,293 in interest savings.
That's insane. That's like the whole balance that you started with.
Exactly.
I mean, it's almost exactly the $2,000 difference.
So although it sounds like a bad thing, hey, I'm going from a 2.6% interest rate to a 7%. Whoa, like that's crazy. I didn't stop there. I'm going to get the other gold nugget. What's going to happen to interest rates? What goes up
must come down.
Right? It's going to come down. So I used the figure of, let's just use the same number that we're at, the 547, in another year, 2 years, when the rates go back down, and let's just say he gets a 4.875, his new payment would drop down to $3,410. That's an additional $1,009.
That's another $1,000. Yeah.
Just imagine if you apply that back to that.
Well, yeah. Now you're not done in 15 years.
Shoot,
you're done
in 10,
12. Yeah.
And the math doesn't lie. The cool thing about this mortgage accelerator calculator that we have, it has the schedule of amortization, so it'll show you how it goes.
We're going to put that in the comment box. So there'll be a link directly to the mortgage calculator in the comment box if you're watching this segment of the show, so that you can use this for your own benefit. Or also, if you have a scenario you want Will or Brian to run by, you can call or reach them by email, and they can actually run the mortgage, the home mortgage accelerator calculator with you.
Yeah. So that's what I use. If I can help you pay off your house in 15 years and save you about $400,000 in interest, would that be something of interest? And they're like, of course. How do I do that?
That's super crazy because we get stuck in this little this conversation cycle, and even in the comments, rates are high. How can you be telling people this? And that's not setting up. You guys are part of the problem. It's like, look, I can't. Look, this guy's already having this issue.
Yeah.
We could be helping this person solve their problem or not. We don't have to. Okay.
Yeah.
So all you trolls and haters, we don't have to do this, but we are, and we'll talk about it. So when you want to talk about helping people save their house, by the way, VA, which that means they're a veteran, right, Memo?
Correct.
Okay. So they're a veteran active duty military. You can be mad about us at that too. So here's my point. Don't be the person standing in the way of someone else getting help. Also, on the other side of that coin, if you know somebody who needs help that could benefit from something like this, having a conversation, being honest and candid about it, and using math to make the decision, that's when you give us a call. That's when you give us a DM.
That's exactly right. I mean, hey, we have the proof. The proof is in the pudding. All the numbers are there.
I think it was beautiful the way that you broke everything down for them and shifted their mindset from saying, hey, I don't want to pay this because I'm going up higher. Yeah, everybody right now says higher is worse. But if you break it down and really give them the true math and the numbers, it's a no-brainer.
That's crazy because, look, if you tell someone they can save $414,000 and they have their house paid free and clear, that's something you actually have to consider. Like you'd have to then have so much money that's not even worth your time considering to not consider it.
But here it comes, guys. I also had a hard time thinking about that, right?
Yeah.
Because I see, hey, you're at a 2.625 at a 7%. Like, what the heck? But if you reinvest it in yourself, that's the power of it. Because now you're paying down principal. It's like the compounding and reverse compounding effect, which is in your favor now because you're paying down interest. You're saving more money by paying down principal, right?
Hey, that's a really quality point. I want to make sure people understand this. The rate doesn't tell the story, number one. Yeah. And number two, just as we look at compounding interest, it's not just about the interest rate itself, but it's time in the market that makes the biggest difference over time. Same in this situation. It's the time and the money you spend at that 1228 clip, adding that to your mortgage acceleration payoff, that gets you to that net result of paying it off in 15 and a half years versus 30. That's crazy.
And that's the difference too, when you're able to break this down and think about how do you reinvest in yourself. And most people talk about like, hey, you know what? I want to create generational wealth. Well, how do you create it? First, you have to get out of debt.
Yep.
Second, you have to understand where you're going to start investing in yourself, right? And so we're talking about all this interest that you have in your home. Well, guess what? If you reinvested in yourself and you continue to have a job, maybe later down the line, in case of emergency, break glass open, you refinance, you use some of those funds to place them in another investment vehicle. Now you have 2-3 vehicles are actually working for you, not against you. Yeah. You know, when credit cards are vehicles that work
for you and against you, depending on how you use them.
For you just to buy it at that moment, but then they're always against you. You know what I mean? Because the rates get higher. And this is another thing what people don't understand on credit cards. You know, and this is what's happening, obviously, with the history that we already talked about earlier, about credit card debt being at its highest level ever, historical high ever. You know, people will surpass, if your credit limit is $1,000, they don't read the fine print, right? Once you go at 1,001, 1,003, the credit card companies are like, Brian, please, thank you for charging that. Because now that interest rate that they said that it was going to be at 8 and change is no longer the case. Now it'll be at 32. Read the fine print. There you go.
Absolutely.
Read the fine print.
Yep, that's a good one.
Okay.
So
nuggets.
Brian, you have a scenario too you wanted to talk to about today. Let's talk about what scenario of the mortgage solution in the market do you have today?
So I had a buyer that we closed on, last week as well, and their biggest concern was that the payments were too high, which is a lot of people's issue right now, affordability. So after we took a time to break everything down, go over all the numbers, I noticed that they were very smart with their money. They had multiple retirement accounts. They had money put away in different accounts. And I was like, okay, they're investing for the future. They look at it long term. Their biggest thing was that the payment wasn't going to work out for them. So they ended up getting their offer accepted for $660,000. They were going to come in with 5% down, which is $33,000. The client wanted to put $50K and say, no, I'm going to put $50K. I'd rather bring my payment down. Like it is what it is. I want to put $50K. I said, okay, great. Let's look at how that looks, right? So we put in the $50K, but then I said, hey, what if we bring your payment even lower and we still use that $50K? We're just not going to put it for the down payment. So what I suggested was, hey, let's take that excess funds that you were going to put. Let's bring your rate down, buy it down. And what we did was buy it from 7.5% down to 6.990. So that in itself saved them around $250 in just their monthly payment.
Yeah.
Similar to you, it doesn't stop there. When I said I noticed that they were smart with their money, what do buyers have an option of? Impounding their taxes and insurance or not impounding their taxes and insurance? So since I knew that they were smart with their money, I suggested, hey, would you guys be okay with utilizing this money that you're already going to pay, but put it in an account that's going to make you a little bit more money? Hey, I'm not your financial planner. Talk it over with your financial planner. But if that makes more sense, now you could save another $822 a month. And I broke it down. You have to pay property taxes twice a year, in the middle of the year, at the end of the year. So make sure you're still responsible for those. They completely understood. So that in itself brought their first year payments to $1,072. Just right off the bat, first year they're going to save $1,072
every month.
Based off just what they did. But then it doesn't stop there. We were able to negotiate a one buy down. So the seller additionally gave them more funds to bring down their rate down to 5.990, which then gave them an additional $400 in savings. So total for the first 12 months. So for the first 12 months, their payment and their savings are going to be $1,484 lower.
Yeah.
Wow, that's crazy.
So my biggest thing from this was, okay, rates was an issue, great, but we care enough about our clients that we break everything down. We get really into their lives, honestly, and say, hey, well, based on your, how you do life, this would be a great opportunity for you. They just had a baby. They were ready to get into the house. So this literally, they're like, now you gave me such more relief in being able to take on the new responsibility of being a new dad, being a new mom, and not feeling like I have this huge burden of having to pay every month a sub 6%. I mean, a plus $6,000 payment. Because that's literally what it was.
That's really good. That's really good.
So hands down, if you're able to get creative and just find the right information that's going to suit you and then break it down in a way that it makes sense. Like what I've noticed from both our conversations was that we broke down the numbers, even though they're scary. People don't want to pay higher rates. Oh my God, these numbers. But once you really break them down and you actually see them, have them understand what you're trying to do for them, they themselves are like, thank you so much. And that's why I love doing my job.
Well, see, that's where we become. I don't want to say a financial advisor because we're not licensed to be that, but at least we're over analyzing and we're asking the right questions and giving the right information to help them make the best decision for their family and themselves as they move forward. And the cool thing about it is we already know rates will go down. They will.
They'll eventually be there,
If it's going to take a year, 2 years, this is not a forever story,
right?
And so when they go down, that's where even the greatest benefits will come into place.
And the thing, I mean, we talked about this before, and for people who just joined the show, you probably missed some other episodes. We talked about this. The market will create creative solutions for scenarios like this. I mean, because on the other end of this deal that Brian's talking about, there's a seller who needs to sell right now. For whatever the reason is, that seller's like, hey, I got to get out of this house because I want to, have to, whatever the reason, doesn't matter. That seller needs a buyer who can afford to come in, get the house so they can get their equity and have their seller proceeds to go do whatever they got to do in their life. So, this is another example where there's like a number of different options here, Brian. We're talking about, using money for the buy down and then having the impounds and paying your tax and insurance on your own every single year or twice a year. And then the 1-1 buy down for the seller contributing to that. Like frees up the entryway for the buyer to come in, and then the seller gets what they need too. So I love these kinds of stories.
It's a win-win.
No, it's great. Hey, put your money in, what do we call that
money
one
market.
bank?
Because did we not just pay attention to what we were saying? It's paying 5%. I'm like, bro, you'll make some money on your money. Like property taxes is just going to take it all. At least you're making money on your money.
Well, here's the thing. The banks will utilize those money to make money is how it is.
But at least you make money on your money.
Now you're your own bank. So no, cool. Pat yourself on the back.
Yeah, what a great scenario, Brian. That was awesome.
Boom.
Good job, guys. So if you're watching the show and you need a solution, whether it's a cash out, home equity line of credit, you're trying to do room addition to your house, build an ADU, buy another house, buy a second house, buy an investment property, like we're still seeing all these things. We're still talking to people about all these things. Ask us so we can help you too.
That's it.
Okay. Zillow execs imagine a world without a buyer's agency. I don't think so. I'm going to say that right. Of course they do. They're like, we don't need buyer agents. We have us. If buyer's agency does disappear, Zillow is considering models where 1 or 2 large portals offer pay-to-play inclusion on a digital listing marketplace. Okay, guys, let's go after them. Go.
All right, so Rich Barton, a very sly way of basically getting in there and saying, hey, well, we're not hoping that this happens, but luckily we have this platform that is just, suited for exactly what's happening.
We just so happen to have this little thing.
But this is what he went on and said. So from where we stand, it seems clear that these principles are in the best interest of movers and consumers, agents, and the industry as a whole. We expect the industry changes resulting from this lawsuit or ones like it involve commission transparency and negotiability provisions similar to those in several of the settlements in the plaintiffs entered with other real estate franchisors in advance of the trial.
So here's the thing. They don't mind disruption. They exist on disruption, and that is kind of the formula for them. Now, the thing about eliminating buyer's agents for me is somewhat improbable. Not everyone has become comfortable with buying a house through the internet. We are comfortable with looking at houses through the internet, but I will advocate even at the front end of this topic, how many of our friends that invest in real estate do not buy sight unseen?
Yeah. None.
I need to go see it.
No,
you can show me all the pictures in the world. What's behind that wall?
And if
what's
they
underneath
don't,
that bush?
And here's the thing: if I'm an investor and I'm buying a house in another state, somebody's looking at that.
You got walkers to go look at it.
You need to know what it's looking like. You're not just going to buy a free clip. Like,
you know what's crazy, guys? Like thinking about when I first got in this industry back in 2005, Zillow was a data source place.
Yeah,
it was just data. And then all of a sudden they came like, hey, let's send you leads. Like we'll we'll put your listings out there, and buyers will call us, and then you're gonna pay for zip codes, and then we'll send you the buyers.
How'd that play
And
out?
then they started now, hey, we're gonna get into real estate. We're gonna go ahead and buy homes. You know, there was a time in Pasadena, one of my clients bought the home. They bought it for 1.2 and a half. And then when I look at, public records, you see the last sale date, it was for 1.4 and change.
Wow.
So they lost money, and then they had to renovate it and stuff. So I know they had to lose. I want to say it was about 200,000, which I was scratching my head like, how does that happen?
Yeah.
Right. So that's just to tell you, fintech companies, they thought their algorithms on finding values and all that was so great that's why in 2021, I want to say, don't quote me, but you can Google this. But in 2021 is when they stopped doing the whole iBuying.
Yeah, it was 21 or 22, one of those years where they actually said, we're out of iBuying. It didn't really work out the way they wanted it to.
They lost their butts off.
Yeah.
So here he goes again. Now, I was saying earlier how they're doubling down and just saying, hey, now we're going to go and get market share.
Well, and this
That's
conversation,
what I'm looking at us.
This conversation came up because of the lawsuit, and they spent like part of their quarterly earnings call talking about this, what they call the elephant in the room, with these lawsuits that are coming out with regarding buyer commissions. But they're trying to insert themselves in the conversation more so because they have, any company that has a loss on one side, you're trying to make that up on another some other way. I do believe that they think they're in the prime position to do that. Yeah. But again, they are heavily reliant on MLS feeding them API data straight to their platform.
Yeah.
So if they're gonna say, oh yeah, well we're totally behind, this whole buyer commission thing and these agents and all these brokerages keeping the commission structure high on sellers and buyers. They're literally going to go, okay, well, we're going to have a pay to play. You know who does that too? AutoTrader. And it's not because I hate AutoTrader. AutoTrader is a great service. You have to pay AutoTrader to list your car on AutoTrader. Yeah. So guess what? You're not going to just get a listing for free because nothing is going to be done for free with any of these big fintech companies. It is a long play for sure. And I think that, I don't know that everyone's going to follow right away. I really don't think they will because for people... Take a step back. Most people, their home is the largest asset they own.
Yeah.
Their monthly payment is their biggest monthly payment they have. And the tax benefit from their monthly payment is their largest tax relief for most people, non-business owners, the exception, right? So I don't know that people are going to follow. Do you think people are going to just follow Zillow in this direction and go, yeah, I'm going to have a buyer agent free transaction? Do you think they're going to do that?
I think Zillow's trying to position themselves as the Robin Hood MLS for the people and say, hey, yeah, we're free and clear. You guys could come and basically use our platform because they believe in, having everything more accessible to everybody. But then at the same time, how do you run a business if you're a business? But
what happens when MLS just says, okay, fine, shut off. We're not going to give you data anymore. What's going to happen?
They'll be non-existent.
But,
right. So here's where
we're making them strong.
But then at the same time, we stop paying them, they start giving us. So it's kind of like we're both in bed.
Yeah, but that's the thing. Is that MLS and all these other they're allowing that access to be they're allowing all that data to be accessed so that it can be promoted and marketed. It's one of the advantages of having an MLS is you can have your property managed in all these other places. That's great. However, it's also the same thing. That's the funnel feeding that same system. So I'm not saying I have a perfect solution for this. I'm just saying that being the problem, it is not going to be an easy solution. It's going to be a long play. It's going to take a long time. I don't think people are going to follow suit very quickly because they're slow to change. Like we saw in an early article, the industry is impervious to change, and when they do change, it's usually very slow.
Yeah, and here it is, guys. They just appealed that. Keller Williams and NAR, they just said, we're going to appeal this. This is crazy. I'm just wondering why others aren't joining the fight with them.
It's very curious, isn't it? I wonder why.
Don't raise my hand. Don't look at me. Don't ask. Don't tell. I don't want no.
We need Poppy Buffett out there, Poppy Buffett goes in there.
I think there's a level of that where it's like if you see a bunch of people scrapping on the side, like if I don't need to get in there and get scratched, I'm not going to. But if I need to get in a dogfight, okay, let's go in a dogfight. I think some people are acting that way right now.
But not realizing that's going to have a long-term effect.
Of course it will. Of course it will. Unless, and this is going to be conspiratorial, but unless they are already getting some sort of benefit from the outcome of this down the line sometime soon.
Who knows?
And that's just not known at this point. It's not public. Yeah, possibly.
Yeah.
But so back on the whole Zillow thing though, like this, they actually mentioned this on their call. They're talking about they're focusing on delivering a housing super app, a tech-enabled end-to-end platform with products and services that make it easier for people to move. Well, yeah, okay, that's super cool for them. But again, will people do this? Like, I don't know. I mean, developing a housing super app is very vague.
Yeah.
I don't think that you're going to see the expiration of independent mortgage brokers. I don't think you're going to see the expiration of local realtors. You rely on local expertise, especially if you're coming from somewhere else outside. People PCS here to San Diego, and I can just use that as an example in our own backyard. They rely on people that have lived here, that know the area, that know the ins and outs, the best neighborhoods to live in, the best schools. They rely on that data when making a choice to where to live. You don't just move to San Diego from Virginia and buy a house because you saw it on your phone. You have to do other things, especially when you have a family, and I think that's going to carry a lot of weight in this moving forward.
That's crazy. They're going to have a drone pick up all your furniture from Virginia just in one.
You're going to have a drone.
Bring it back over here, and then they're going to stage your home with your furniture.
It's like the big
you're probably going to have to go
Claw.
and have an app and look and see in each room how you're going to place your bed. And I don't know.
You're
Maybe
going to
it's
have an
cool
Alexa.
like that.
You're going to open the door. Alexa's going to be like, "Hey, welcome to your house.
Yeah.
What features would you like to know about this property?
it's
going for this much bedrooms."
I just came up with an idea.
You know what?
Would you like to send out an offer now?
It's like at the arcade, the little crane game. You just move the crane to your house, and pick up your house, and move it across country and drop it.
And then you're going to have iRobots, Will Smith, iRobots. You
Oh
guys
my
watch that
gosh.
movie?
Yeah.
They'll move everything in. So who knows? I don't know.
I don't think that. I mean, look, I understand from a business perspective. Yeah, Zillow's going to make a move. Of course, they're going to envision a future without buyer's agents. I don't know that consumers are going to envision a future that way, because I can look at other industries too, and I go, you know what? Yes, there might be some better technological solutions for certain things, such as tax preparation, trust and estate. Not everybody goes to LegalZoom to do their trust. They just don't. You know why? Because there's still a lot of trust attorneys around, and they still pumping them out of law school, and they're still starting their career. And we're actually going to have some come on our show in this quarter for the new year. So, I know that is not always the mass doesn't always go in the same direction that tech does.
Here's a crazy thing. When COVID happened, everybody was isolated. You got to stay at home, and people thought that was pretty cool, until it wasn't. And then next thing you know, it's like, oh no, I want to do everything. Remember, we couldn't go to the toilet just without taking a call. It was crazy.
Every 2 seconds.
Going.
Horribly great.
And then everybody's like, please just email me. Please just email. I'd rather do everything email. Prior to that was a face-to-face, that's how I like to work, right? Like I want to put a face to the name, kind of get along, see where we're at, see if we're going to be that good fit and how I can help them more, et cetera. And we started getting away from them. Started in, towards the end of 2022, I felt like I had atrophy, like when you break your arm and it takes a while before it kind of gets together.
Yeah.
I felt like that was how I was communicating when I would see people. It felt like relationship
how do I do
atrophy,
this?
like,
Atrophy,
oh man,
Yeah.
like we're starting to forget about that.
Yeah.
And now you're starting to see people coming back and wanting that face to face. Like, oh, I got to see that now.
Yep.
That reassurance.
That reassurance.
Yep.
So,
100%.
and I'm glad that,
I push
we're
for
kind
it
of
too.
going back to the Leave It to Beaver age, I miss
a
those
little
days.
bit. Yeah, I think people have that sentimentality about themselves too, and they just want to experience things the way they still like to, and we are seeing more people come in because of that.
Oh, yeah.
So.
Oh, yeah. I love seeing The Office, everybody here.
Yeah.
When it was just me, myself, and my shadow, but that's the way it had to be, right? Because otherwise there was like...
That's the way it was.
Peace Patrol out there just arresting you. What are you doing out here?
Being a human.
Yeah.
So, all right, guys, let's wrap the show. Memo, what was your favorite part of the show today?
My favorite part of the show is that if you can save money, you can reinvest in yourself. You kind of forget, again, it's that atrophy, reinvest in yourself. If you have the right people surrounding you, you're going to get the right information and the encouragement to go out there and really set yourself apart. And not just set yourself apart from friends or anything like that, but set yourself apart from yourself of understanding there's a bigger picture. There is a way you can create that wealth with just minimal savings every month if you're placing in the right place. And that just encourages you to even take it a step further.
That's awesome.
And that's what I'm all about,
Awesome. How about you, Brian?
Great. Mine was the rate doesn't tell the story, and it's time in the market. A lot of people want to time the market, but what we've seen these last couple of years is you can't time anything. What the only thing you can time is your goals and how you're going to go about them. So I think if you're looking at stuff long term, right now there is a lot of opportunities. So don't let the rates discourage you. As we heard, there's plenty of ways to minimize that rate, minimize the payment. So I would just stay, very cautious about your long term goals, and every decision you make, just make sure it aligns with that.
Nice.
Yeah. And for me, guys, it's both of you coming to the table today with a very quality example of how people are using the mortgage market and their mortgage and their home and their equity or the opportunities of a buy down in order to secure real estate and then make the most out of the real estate. We always talk about how, our education, our Monday Mortgage Minute, our podcast here, our conversations with people, is to help people, to share with them and help them understand how to make the most out of real estate and mortgage. And that is why I'm impressed today by both of your scenarios. Those are very quality examples that are not only real for those two people, but real for other people watching. I think it's important that people hear about scenarios that sound like them, so they go, oh my gosh, I'm known, I'm seen, and there's a solution that exists for me. Because again, unless you're sitting here in these rooms and these offices or these types of conversations, you most likely don't know that there is a solution for your particular problem, or at least that there's somebody who can actually hear about it and then assess what can be done. So I am really proud of you guys. Thank you so much for doing that. And I'm really hoping that people that watched today's show will look at those two scenarios and think of themselves or someone they love who they can help out too.
Yeah, there's light at the end of the tunnel.
Always.
And there's other people that are going through similar situations. So.
All right. Well, thank you all for watching the Mortgage Heroes Weekly Podcast. We are hopeful that if you're on YouTube, you can not only subscribe to the show, turn on notifications so you catch every episode. And for those of you listening on Google and Apple, make sure you get direct download every time we upload a new show. Thank you for joining me again this week, guys. And we'll see you again next week.
That's it.
Bye, guys.
See ya.